So in the world of forex trading, there are a couple of basic terminologies that you need to know, because a lot of traders, they use all these terms, and sometimes beginners might get a little bit confused as to what they mean by that. So that's why you need to know the lingo of forex traders before you go into trading. Alright, so the first very common one is the base currency and also the quote currency. What does it mean by base currency? It means that any currency that's on the left side is called the base currency, and any currency that's on the right side is called the quote currency. For example, let's say you are trading euro dollar. So euro would be your base currency. Then dollar would be the quote currency. Similarly for dollar yen, dollar would be the base currency on the left side. Then yen would be the quote currency on the right side. And of course, a very common term also, long and short position. So let's say when a trader tells you that I'm going on a long position in euro dollar, it means that he or she has made a buy in that position. So when a trader tells you that he or she made a short position, it means that they made a sell on that position. Bull and bear market. A bull market is a market that is going upwards, whereas a bear market is a market that is going downwards. Alright, so aside from bull and bear market, you also have market that goes sideways. So when the market is going sideways, a lot of traders would call it a ranging market or a consolidating market. Spread, and this is a very common term used by brokers. So what does it mean by spread? It is the difference between the bid and ask price. Okay, the difference between the bid and ask price. What is the bid? So a bid is applicable to a sell, whereas an ask is applicable to a buy. Leverage. Now this is more related to risk management. I'm going to elaborate more on this under the risk management section. But what does it mean by leverage? It's the ability for you to control a larger sum of money by using a smaller account size. So margin is also related to risk management. What does it mean by margin? It is the amount of money that you need in your account for you to open a trade. Okay, so I'm going to elaborate more on this when I go on to the risk management section. Hedging. Now this is a common strategy used by hedge funds all around the world. They would hedge the market. What does it mean by hedging? It means that let's say you have an open buy position today. You also at the same time open a sell position, so that in the event that your buy position didn't work out, your sell position would so-called cover up your losses. So this is what I mean by hedge or hedging. So some retail forex traders, they use forex as a tool to hedge against the other asset classes that they are invested in. Okay, so not all traders trade the forex market or speculate on it. So especially for companies, they would use currencies as a hedging tool. So another common term that is used is pips. Now pips is actually the short form of percentage in points, or some people call it the price interest point. So what does it mean by a pip? It is the smallest price movement in a given currency pair. Think of it as a metric to measure your performance as a trader. So a lot of traders use pips to measure whether they are making money or whether they are losing money. So of course, a lot of traders also use pips to calculate their lot size. So this one, I'm also going to elaborate more on it when I go to the section on risk management.